floor is open for questions and comments and alternative views. Antoine. Usual drill, take the traveling mic, stand up at the back, introduce yourself first, and then fire away.
Antoine van Akmal, Emerging Markets Management. As you know, I am usually an emerging markets enthusiast, but I have actually a slightly different perception at the moment. I find it surprising that you project really quite a high rate of growth for 2010 and 2011 in emerging markets, when at the same time you and your colleagues mentioned that we are going to see less stimulus and a lot more basically interest rate hikes and probably stronger foreign exchange rates. How do you combine that? I personally am less bullish on growth in emerging markets, at least for the next 4 quarters.
Arvind and Mike, you both want to pick up that mic?
Well, of course, the tightening of monetary policy is itself a reflection that growth has been strong and is expected to remain strong. The growth rate for emerging markets as a whole of 6% are thought to be about in line with potential growth, or a little bit above potential, but the IMF's assessment of sort of a longer run growth prospects in these regions as a whole is more or less consistent. So this is not a whiz-bang growth period for these countries. They have high growth potential, and it's normal to see monetary policies firm up to what would usually accompany a sustained expansion. I believe we'll see that in the United States, too. Not this year and probably not next year, but if we get a reasonably well-sustained expansion, we're going to see the federal funds rate back up in the 4% range by 2012, 2013. As far as the exchange rates are concerned, you want to keep in mind that these countries suffered very large trade losses because of the global contraction. I think in an environment of expanding world economy in the industrial countries, even with moderate exchange rate appreciation, they can continue to enjoy reasonable growth. Indeed, what I think we really need for the global economy to have a well-sustained global expansion is that the level of current account imbalances shouldn't grow very much, at least not for the major countries. So that we don't need China to shrink its current account surplus. We just need to have its imports grow as rapidly as its exports. And the same, on average, needs to be true for other emerging market countries. And similarly, we can't build our recovery on expanding net exports to the rest of the world. Expanding exports can be an important part of the recovery, but I anticipate our imports will go up along with our exports, as I hope will be true in the rest of the world as well.
Arvind, you want to add anything? Okay. All right. Floor is again open. Bob?
Fred, thank you very much, and thank you for this excellent panel. And compliments to Dr. Mussa. Hope that you can repeat the feat next year with your forecasting victories. I guess my question is that, concern is that nobody mentioned trade expansion, global trade expansion, as an element in economic growth and recovery. If we believe that trade expansion is good and good for our economy and the others, yet that we're not having, we're going nowhere with trade liberalization, and let's say the emerging market and developing countries are growing at the rate they are growing here in this table 1, and particularly Asia doing so well. How do we convince them at these rates of growth, these rich Asians and some others, that trade expansion through liberalization is in their interest?
I think it's often forgotten that one of the remarkable things about this crisis, given the magnitude and the severity of the trade decline, especially in the first 2 quarters of '09, that despite the strong decline in trade, we saw very little trade protectionism around the world. And we had pockets of protectionism mostly in the U.S. with the financial sector and to some extent with the auto sector. But what's been remarkable and something to celebrate, as I wrote in the Financial Times, was that this is really noteworthy, and it shows that the number of reasons why this has happened. One, I think we probably did learn some lessons from history from the Great Depression, and also because I think global production chains, etc., have become so interconnected that it's very difficult to resort to protectionism and not end up hurting someone you don't want to hurt. So far from needing to go around trumpeting the virtues of further trade liberalization, I think we should celebrate the fact. I mean, obviously, we should see some trade liberalization being pursued, but I think we should celebrate the fact that we didn't see any rollback despite such a calamitous drop in trade.
Yeah, I would just add to that, Bob, you put your question to the emerging markets. Why don't they see the virtue of more liberalization and a resumption of rapid growth? I would put the same question to our government here at home. The administration, to its great credit, has posited a national export initiative, but has done virtually nothing to implement that strategy or really put any policies in place to promote it. The lowest hanging fruit is, of course, to implement the free trade agreements already negotiated. And there's some reasonably decent studies that suggest that, a little bit contrary to Mike, we would probably get some net export expansion from those, which, whether it's net or gross, would create a fair number of well-paying jobs. And if you have a serious intention to expand exports, well, you should at least implement agreements that will open foreign markets that will enable you to expand exports. Seems rather axiomatic. Likewise, other trade negotiations could also promote further export expansion, job creation with it. At a time of high unemployment, that seems to make sense, even with the time lags involved. So I think the point's a fair one, and picking up what Arvind said, basing on the reasonably optimistic outcome that we've not had a big backsliding, but still worrying that if you don't start to move forward at some point, you may accelerate the backward slide. It would seem prudent and sensible to do that. And with a stronger economic environment, the case for doing so would seem to be improved. Charlie.
Yeah, I'm going to be a bit parochial and talk about a U.S. problem that's really internal to the U.S., but it may have some minor effects on the rest of the world. And that's the long-term debt problem, what we call the long-term debt problem. If you go back to, well, first place, we've known about it for a long time. It's substantial. But, people generally thought about it that this was really something that budget gurus and economists worried about. And we had plenty of time, so why diddle around with it now and take some painful steps when you can wait? And in 2007, the Congressional Budget Office, if you average its optimistic and pessimistic projections, put the date at which the debt-GDP ratio really started to accelerate at sometime 2.5 decades from now. Well, in the 5 years between 2007 and 2012, we all of a sudden jumped history 2 decades forward. And by the year 2012, with the the OMB's they published it, new long-term debt forecast, in 2012, instead of 2032 or 3, we will be just barely entering that trend upward, which will accelerate every year, starting small. The question is, given that literally 20-year bringing the present future up to now. And even though financial markets don't really look as far ahead as most people think, you're going to start floating 20, 30-year bonds. You're well inside this upward trend, which there's no sense whatsoever, given recent congressional actions, that anybody's going to do anything about. Could it conceivably be, Mike, that you're not in the next year or two, but if you go out a little further, you're, particularly with your bullish projections, we could be in trouble with higher long-term rates, even widening the gap as you go up to your 4%.
Well, my colleague at the University of Chicago, the late Victor Zarnowitz, was a great student of economic forecast and economic forecasting, though not a forecaster himself. And Victor told me many years ago that after studying this issue for much of his career, he concluded that economic forecasters had some capacity to do better than the naive forecast to project last year's growth or project the trend growth out about 18 months to 2 years. So my forecast covers now through 2011. I don't think that this problem is going to bite us before then. I reserve judgment on at what point it's going to begin to become an important negative feature for U.S. growth. Now, I would note that if you look at U.S. interest rates in the Treasury market, and convenient thing to do is, used to be the Wall Street Journal and the Washington Post published this stuff, but since all newspapers became essentially useless as sources of information, it's only Barron's that publishes this, and only weekly, though you can download it online, is the table on the interest yields on Treasury's zero coupon issues. And you can calculate very easily from that the 1-year interest rates out 29 or 30 years by simply taking the price of the 20-year coupon versus the price of the 19-year coupon and dividing one by the other. And those interest rates, those 1-year interest rates, are very low this year and next year. They get up above 5% by the time you get 5 years out and go up to around 6% by the time you get 10 years out. So I think the market already has built into it some expectation that longer-term interest rates are going up. The Fed can keep it down in the short run, but the market suspects that in the longer run, interest rates are going to be higher. I think the concern is probably not that interest rates would go up to where it's now indicated, but they'd be 2-3 percentage points higher. Then that's going to be, assuming inflation does not go up by the same amount, going to imply real interest rates at a level that are above what we've seen during the sustained expansions of the 80s and of the 90s. Unless we do something serious to adjust our fiscal path over the next 5 years or so. Not all to be implemented over the next 5 years, but put in place policies which will, as they say, tilt the curve downward. Then I fear that within my lifespan or your lifespan, we may see this problem come forward. I think not by the end of 2011. Bill?
I was puzzled by one thing, and then I'd like to bring up another point that's, I think, very closely related. That is, Anders pointed out the quite successful performance of Poland, due in large part because of their very good independent monetary policy. Yet he then recommended that they get away from independent monetary policy and join the euro area, which I found a bit puzzling. And secondly, I remember, at least I remember some days at this age, that from 1971 to 73, we were not incredibly successful leaving Bretton Woods with successive revaluations of the currency. Why do we believe we're going to be any more successful with China leading the current neo-Bretton Woods with successive revaluations? In other words, a point that I've made before in this audience is an international policy problem now. the price that China sets for its currency or the fact that China sets the price?
Yeah, thank you. A good point. You can say that we have two success roads here. One is the euro, and one is to have good inflation targeting. Two countries that had inflation targeting, Romania and Hungary, fell for the easy temptation to have too large budget deficits. So out of the countries in the EU that got IMF programs, two had inflation targeting and one had currency boards, while the two East Europeans with Euro, Slovakia and Slovenia came through very nicely. So there are two alternatives. But it's only Poland and the Czech Republic that look good with inflation targeting.
On the question about successive revaluations, Bill, there are many, many examples of great success with that. An upward crawling peg system has been used by a number of countries over the last 30 years. John Williamson has written extensively. Obviously, you have to have corresponding domestic policy measures to make it work, but if you have a consistent whole, it works very successfully, and John's documented many countries where that's been the case. As the Europeans, remember, planned for the euro and had the ERM, they did a succession of modest currency realignments all through the early 80s into the late 80s before they then locked in rates prior to going to the euro. Those were orchestrated and coordinated very effectively. Now, you can say the Europeans had a system coordinated better than might happen in Asia. I think that goes to Arvind's call for a much more effective intra-Asian monetary cooperation regime, and they do need to do that. As it works now, a number of the Asian countries just shadow the renminbi, either sort of one for one like Taiwan or maybe half for one like South Korea, but willy-nilly, more than coordinated as in the ERM case, they do move up more or less together, and I think that probably will assure fairly successful outcomes from what will be, again, an upward crawling peg as China lets its currency start to appreciate gradually.
My reply to that is all of your examples, the countries are relatively small relative to the reserve currency country. In the case of Japan and Europe when they were leaving Bretton Woods, they were not small relative to the reserve currency country, and neither is China anymore. Okay, so what you're going to get as China successfully revalues, you got a one-way bet with their rate of return higher than the U.S. The U.S. sets a price, okay, supplies all money and credit at that price. You got an infinite demand to borrow in dollars, place it in China. That's just going to lead to an exploding bubble in China and a bubble in commodity and oil prices, just like you had 71, 73.
Well,
we had exactly the same thing in 71, 73.
Nick's not here and could respond to that, and Mike say something. I think if the Chinese recognize the problem you're talking about, as they recognize they've got to appreciate the currency, the smart way to reconcile the problem, of course, is to do a bigger jump at the outset rather than do minuscule monthly changes. What I've suggested to them is that they surprise everybody, do a one-shot move of, say, 8 to 10% here in the near future as they get ready to unlock the peg with the dollar. Let people know if they want that that's it for this year, but I think that would not only avoid the acceleration of speculative inflows that you point to, but would probably generate some speculative reflows. People would take profits, say, okay, that's it for this year. We pocket our 8 to 10%. We move back out. There'll be a guessing game a year hence when they have to make the next move, but I think that's the way to deal with the technical problem you described.
Why would you move out if the rate of return's higher than it is somewhere else?
You'd pocket your capital gain. Well, it depends. If you still think staying at RMB is going to get you a higher return, sure, you'd stay. But the hypothesis is a lot of people have moved in purely to take a capital gain on the exchange rate move. If it happens by an amount big enough to justify that bet, and you don't think they're going to do it again for a year or even longer, I think the empirical record is people will take the capital gain. Right?
It'll be interesting to see.
We'll see. If they do that, I hope they have the wisdom to do that. Mike. Okay. unfortunately, we're at the witching hour. I thank all of you for coming. I particularly thank Mike, Arvind, and Anders. They won't get raises, but it was a nice try, and I thank them for the effort.